We've seen a nice recovery through the course of last year. Growth went from down around 1% up to just above 2%, driven by consumers and, of course, businesses. If you put the brakes on too quickly with interest rate hikes, we're talking more to come, then that could nip that recovery in the bud.
Welcome. On the back of the latest inflation data, why do you believe the Reserve Bank will probably hold rates steady tomorrow?
Look, to be honest, Kirsten, it is a very close call. Our initial knee-jerk reaction was that they would hike after seeing those inflation numbers. But when we looked at the detail, you actually see quite a distinct downtrend in the monthly trim mean, which also underpins a downtrend in the quarterly trim mean, which the RBA, of course, will focus on. And you go back to July, the monthly trim mean, this is the underlying rate of inflation that the RBA focuses on, was 0.47%, call it 0.5%. The December reading was 0.2%. Quite a distinct downtrend back to almost being within the target range, or on some ways of looking at it, potentially in the target range. So I reckon the RBA would be wise to wait for a little bit more time to see if that continues to play out. Because don't forget, they gave quite a bearish message or a hawkish message back late last year. If inflation keeps going up, they'll probably have to hike. But they also said they want to see clear evidence of a downtrend. We are actually seeing that. That's why I think there's a strong argument to leave rates on hold. That said, I'd agree, it's a close call.
But Shane, given that all measures of inflation, including the one that the RBA focuses on, the trimmed mean, are above the target band, is there a risk that not hiking in February raises the risk of steeper rises later this year?
It certainly does, and that's why I'm not going to be surprised if they do hike. Many would say a stitch in time is worth 9. Let's nip it in the bud, make sure it doesn't go any further. We do have annual inflation measures, which is the headline, the trim mean, the monthly trim mean or the quarterly trim mean, all above the target range and going in the wrong direction. But I just reckon that when you look at the more recent data on a monthly or quarterly basis, not the annual rates, but what you've seen in the last 6 months, it looks to me like inflationary pressures peaked in the September quarter and are actually starting to come back down. So yes, there's arguments either way here on this, and I totally agree. We've got to get inflation under control. If we don't, big problems for those with a mortgage. They will end up paying higher rates over the longer term, but by the same token, we don't want to nip in the bud the economic recovery we've started to see over the last 12 months because we hike rates prematurely.
Is the strengthening Aussie dollar something that the Reserve Bank is likely to take into account and which could possibly stay its hand?
Yes, that is another factor in there. There's two factors arguing for a hold.
Why is that?
The downtrend of the trim mean and the strong Aussie dollar. And the Aussie dollar has come up very strongly, both on a basis against the US dollar. Sure, it's wobbled around the 70-cent level, but way higher than it was a year ago. It was around 62 US cents. It's also gone up on a trade-weighted basis against a basket of other currencies. And that is a de facto monetary tightening because, for one thing, it means that import prices will come down a little bit. There'll be a bit of downwards pressure there. And it also makes it harder for Australian companies to compete internationally, which again is, as I said, a de facto monetary tightening. And the Reserve Bank has to allow for that in considering what they do here. And there's a danger that if you raise rates tomorrow, with expectations there'll be more to follow. The old cockroach analogy, if you see one, there's usually a few more around. If they do that, money markets will get emboldened and further push up expectations for rate hikes, which of course would then further push up the value of the Australian dollar, again leading to a double whammy in terms of monetary tightening.
And so are you worried that a hike could slam the brakes on economic growth?
Look, that is my worry here. We've seen a nice recovery through the course of last year. Growth went from down around 1% up to just above 2%, driven by consumers and, of course, businesses. If you put the brakes on too quickly with interest rate hikes, we're talking more to come, then that could nip that recovery in the bud.
Shane, the Treasurer didn't agree with your view last week that the level of public spending has contributed to the strength of inflation in Australia. What do you make of Jim Chalmers' argument that the inflation rise we've seen is solely due to the pickup in the private sector?
Look, I respect the Treasurer, and I was also very heartened that he respected me. If I was in America, I might be on a blacklist by now, or might not get back into the country if I go on a holiday or something. So I think it's good that he's open for the discussion around those sorts of things. Yes, his response was that, well, high public spending did not stop the Reserve Bank cutting last year, and secondly, that public sector spending growth has actually slowed, private sector spending growth has picked up. But I would focus on the absolute level of public spending as a share of the economy. Public spending, this is federal and state, is running around 28% of GDP. Now that's a record high in terms of the period over which the GDP numbers are measured back to 1960. And prior to the pandemic, it was running around 22 to 23%. So you've got a high, it's slowed down a bit, but you've got a very high level of public spending there. And as private sector spending has started to pick up, it's banging up against high public sector spending, leading to capacity constraints. So that could be one big factor contributing to this rise in inflation we've seen.
You say contributing. If the RBA does rise tomorrow, is it due to government policy, government spending?
Well, of course, the Reserve Bank will never say that. They don't want to upset the government too much, but I think it would certainly be a factor. The Reserve Bank will no doubt, if they do hike, they'll no doubt cite concerns about excess capacity utilisation in Australia, a lack of spare capacity, demand being stronger than supply. Very hard to argue that private sector spending is too much, but I think behind that is very high public sector spending. So the Reserve Bank is not going to put it that way, but they will say, I think if they do hike, that they're worried about a lack of spare capacity in Australia.
Shane, finally, if there isn't a hike tomorrow, do you expect to see at least one sometime in 26?
No. I think if they hold, they will then see evidence that the downtrend in trim mean inflation that we've seen since about July will have continued, and therefore they'll be able to avoid a hike. That said, I reckon after the meeting, if they do hold, they're still going to issue a very cautious and what we would call hawkish statement, warning that if we don't see a further downtrend in inflation, we will hike. So that warning will come out there, but I think they'll be able to avert that.
Shane Oliver, thank you for the preview.
My pleasure, thank you.